Hello everybody and welcome to this video that will be very much different from the videos we have been launching so far on this new channel. Today we are going to focus a bit on dividend and why you should not only consider the dividend yield when buying a dividend stock. There are other important factors to consider, and we quite often feel that what we are seeing in material published around dividend is being forgotten a bit. So we therefore in this short video want to highlight these elements for you guys so you are in a better position to take a decision on which company you should invest in if you are going for a company that is paying dividend. First, we want to explain what the dividend is. A dividend is the distribution of some of company's earnings to a class of its shareholders. The dividends can be issued in various forms, such as cash payment, stocks, or any other form. And a company's dividend is decided by its board of directors, and it requires the shareholders' approval. It is not obligatory to pay dividend. Some companies prefer to maybe grow the business instead of paying anything out to its shareholders. So you have a variety of companies having different strategies depending on where their company is in that particular moment of time. You also have some companies that consistently over the years have been paying dividends out to its shareholders, even increasing dividends. For those, you can check some of the dividend kings and dividend aristocrats in the US. So in today's video, we have selected 7 different companies to use as an illustration of what you need to be wary about when you are looking into dividend yield. So today's video, we have Pfizer, JP Morgan, Pepsico, Qualcomm, eBay, Visa, and Monster Energy. So if we first take a look at the dividend yield for these companies, we can see that for Pfizer, it goes from 4.12% all the way down to Monster Energy, who is not paying any dividends until today. We have then made a ranking based on, if we are purely looking at the dividend yield, who is paying the most out to its shareholders. However, we also need to consider the payout ratio here. And the payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends, expressed as a percentage of the company's total earnings. So why is this important? Yeah, but if you have here 61% for Pfizer, that means that 61% of their earnings is paid out in the form of dividends, and 39% is used on other things, maybe growing the business. And that means that this company, in theory, can increase its dividends as it wants based purely on its earnings that it's making. And obviously, we just want to illustrate that for some companies like Qualcomm, they're paying 107% out. This is unsustainable in the future because it shows that their pure profits cannot cover their dividend yield. So if we take a look at the ranking here, we will see that there's happened a small change for these companies here in the middle. That is where we say, yeah, but eBay is only paying 1.23%. So it's not so good if you just look at the pure dividend yield. But considering that they're only paying 23% out of the total earnings, we believe that there's a further room for improvement in the future. And we simply weight that higher than Pepsico and Qualcomm. This is just done for purely visual purposes, and maybe some other people will disagree with this, but this is just to illustrate that you can not only look at the dividend yields purely, you also need to look at the payout ratio. So when we are seeing a lot of analysis on dividend paying stocks and how fantastic they are, one of the elements that we often feel is missing is to also look at the buyback. A buyback refers to the situation where the company, perhaps instead of paying a dividend, goes out in the market and repurchase some of the outstanding shares, and they basically retire those shares. So they are taking a portion of the ownership that was previously held by public and private investors, and that goes into the company ownership. This is sometimes another important way of creating shareholder value, and it's extremely important as an investor to also have an eye on this. So here we want to illustrate why we think it is very important to consider buyback as part of your evaluation when you're deciding which company you want to invest in. So if we take a look here on the companies that we are benchmarking, we see that Pfizer has a minus on 0.15%. That means that they didn't buy back shares, they actually issued more shares to the market. JP Morgan had a very good buyback yield of 5.56. Pepsico had a small one on 1.14%. Qualcomm 2.01%. eBay, really big buyback yield on 15.34%. Visa with a 1.94%. And Monster Energy is actually doing buyback with 2.4%. So if we put these two together, we can see here the total shareholder yield. And we then go in and do a ranking based on that. And what we are seeing now is that, just for illustration purposes, eBay is the one paying the highest total shareholder yield with 16.57%, while as JP Morgan is the second one with 9.10%. Qualcomm is the third one suddenly with 4.14%, and Pfizer suddenly is now on the fourth place with 3.97%. Again, there's no guarantees that a company will continue to pay dividend. They may cut it. The same goes with the buyback. They may decide not to do further buyback programs. So there's no guarantees that it's going to stay like this in the future. As previously with the payout ratio, we obviously need to do the same in this situation and look at the modified payout ratio, which considers both the dividend and the buyback part as part of the total earnings that is paid out. And we again here can see the modified payout ratios, and again we would like this to be below 100 as much as possible, because that means that there's further room for improvement. So if we can look at that, we see that eBay has 128%, which is basically a little bit high, because that means that the earnings are not covering both the dividend and the buyback. However, we do feel that considering they're paying a generous 16.57%, it's actually a pretty good buy if you just look at it this way. On the other hand, we now have Pfizer, which is paying only 56% of its total shareholder yield on 3.97%, and we again feel that is very good, so we therefore give them the second rank. Last, we have Qualcomm here, which we see now has a 208%. So they're paying 4.14%, but it's very unsustainable. And we therefore believe that you're only going to get 2.4% on Monster Energy. But we believe that that is better overall, because they can cover this through their earnings, and Qualcomm cannot at all. They will have to cut it in the future if they want to make it sustainable at least. So again, this is for pure illustrations of where you have a ranking looking at a dividend yield, then you consider the payout ratio, a few things changes. You then include the buyback yield, that has an impact again. And finally, you look at the modified payout ratio and you get a more complete and true picture of which is the best and perhaps most sustainable payout ratio. Again, you obviously want to consider a lot of other factors when you decide to buy a stock. So this is by no means the only things that you're going to look at, but it is definitely an important element if you are looking for dividend yield stocks and or buyback, of course. So again, there are definitely benefits of investing in a company that do share buyback. However, there are also some drawbacks, and we're going to look at them now. The benefits first. After the share buyback, shareholders each will own a bigger portion of the company and therefore a bigger portion of its cash flow and earnings. Pretty straightforward. The company will also be buying shares in the market, bidding up the prices of the stock as they are retiring shares. So again, when there comes more pressure, obviously that means that the share price usually goes up. Sometimes it is better value to do share buyback than, for example, expanding the business. That sometimes can be more risky, or it may be better than paying out dividends. Lastly, for some people, there may also be tax advantages to have share buyback versus, for example, dividends. On the drawback side, it's obviously not a good idea to do buyback if the shares are currently overvalued. It tells itself, and therefore the company should obviously understand that fully before launching a buyback program. It decreases the outstanding share count, so earnings are distributed among fewer shares, raising earnings per share. And increasing earnings per share based on this has not increased the fundamental value of the company. So sometimes this can be a trick to boost this without it actually being boosted, and you therefore need to understand why has the EPS gone up. Another very important point that is often a criticism of share buybacks is that the executives gets the bulk of their compensation in the form of stock options. And sometimes they countermeasure this by doing buyback. So basically the company is issuing shares that they give to the executives go out and buy shares in the market, and therefore it becomes like a trade-off. But again, that doesn't mean that there has been more value in the company. Basically, they have reduced the value through giving shares to the executive. And last, and a much important point, is that management sometimes uses debt to finance earnings boosting share purchases. So the company may do so because it believes that cash flow in the future will be used to pay off the debt, and therefore bringing the shareholder funds back into line with borrowings in due course. However, sometimes that doesn't happen, and then you obviously have a big problem if the cash flow is not high enough to cover this increased debt. So that is some of the problems with buyback of shares, and you therefore, again, don't only look at the numbers, go in and check the company and understand how this works, so you take a thoroughly and well-considered decision before buying them. We hope you enjoyed this video. Please like, subscribe for future content. Please leave a comment in the comment section, especially if you have any suggestions for improvement. Please remember, we are not professional financial advisors, and this is only done for entertainment purposes. We hope you have a good day. Stay tuned until the next video. Bye.